Welcome to the Financial Freedom Podcast with your host, Lorna Poole, sharing the secrets to creating wealth, investing, and that all-important money mindset. To find out more and accelerate your journey to financial freedom, head on over to www.lornapoole.com to get started. Welcome, everybody. Welcome to the Financial Freedom Podcast. As an individual investor, there are unique advantages, and my guest experts today, Brian Feroldi, has been striving for financial independence even before he knew what the term meant. Brian struck gold right out of college when he was hired as a successful medical device company soon after it was founded. However, Brian spent all his free time with his true passion, investing. Brian struck gold again in 2015 when he was hired by Motley Fool to cover the healthcare industry for Fool.com. He's been doing this ever since. Brian currently resides in Rhode Island, where he is happily married, working hard to raise 3 small kids. His hobbies are playing games, chess and fortnite, volunteering at the kids' activities, hanging out with great friends, and cheering on the Patriots. Brian, great to have you here.
Lorna, awesome to be here. Thanks so much for having me.
Advantages, right? Why is individual invest an advantage compared to personal money manager?
The only thing to do is to give your money over to a professional, and that is the smart way to invest. But the more I dug into it and the more I've learned about investing, the more I've realized that individual investors actually have a huge advantage over professional money managers, which is just a completely backwards topic. I mean, I can't name any other industry where the people that work in that industry and the people that are the quote-unquote experts with all the information are at a disadvantage compared to novices in that industry and people that have less information. So that mismatch is hopefully something that I'm here to let your listeners know about.
So explain what you mean by that. Explain what you mean by the managers are at a disadvantage.
Yeah, so most people are familiar with professional money managers. These are people that have hedge funds or mutual funds or just do investing on behalf of some other person. It turns out that most professional money managers fail to beat the market's return over time. And studies show that something like 85 or 90% of mutual fund managers just underperform the indexes. And there's a number of reasons why that's the case. Your natural assumption would be that, they're idiots or beating the market is just impossible. But it just actually turns out that the structure of how money managers make money and some of the unique things that they face are huge barriers to them beating the market over time.
So what do you mean by the structures? What would they be?
Yeah, so
can I just say this very quickly? Because I feel like even me, when I was starting my journey, we're not taught about this in school. And I think when we start off, sometimes we can think we just have no idea about money. Right. And I think that's a big mindset that people have to get over. But, I mean, what we're talking about today, so let's dive into it. So what are the structural problems that money managers have, and why should we think about doing it individually?
Sure. So a professional money manager is somebody that goes around and collects assets from friends, families, or just clients and invests those assets on behalf of that client. And these people are typically pedigreed. They've been to school. They've passed some sort of licensing. They have credentials. And you would think they would do a fantastic job of educating their clients and performing well over time. However, the way that money managers actually are compensated is they take a percentage fee for every dollar that they have under management. So a pretty typical fee is around 1% of assets that every year gets subtracted from their investor's bank account and puts into the manager's bank account. That 1% is pretty typical, but if you go to something like a hedge fund, that can be 2% of assets plus 20% of any of the profits. So that fact alone acts as a massive drag on the return of the investors because they are paying a recurring fee that compounds over time. So that's one reason why professional money managers are just at a disadvantage. They have a fee that they have to cover. Second, is that they have something called career risk to think about. So if I'm a mutual fund manager and I'm out there picking stocks in an attempt to beat the market, and I buy stocks that nobody has ever heard of, and those stocks underperform, there's a very real chance that I could be fired. However, if they buy stocks that everybody knows, such as ExxonMobil or IBM or Apple, and they underperform, they're often forgiven because they're buying the same thing that everybody else is buying. So that worry that they're going to be fired kind of limits their investing universe to kind of things that are big and well known. And that constant fear of career risk, which is they are desperately trying to keep assets because that is how they make money. So that is just a huge incentive that they have going on in the back of their head all the times, that they have to prove to their investors constantly that they're worth keeping their assets with. And that just creates some perverse incentives for them. Another kind of limiting factor is that when a professional money manager is very successful, they tend to attract a lot of assets, hundreds of million dollars or even billions of dollars. When you have that much assets, it becomes harder and harder to invest, because when you're trying to buy an individual security, you are literally investing so much money into it that you are moving the price of that security as you are accumulating it. So if you
explain that bit more.
Sure. So let's pretend that you're an individual investor with like $100,000 and you want to buy $10,000 worth of any stock. $10,000 worth of any stock is a very small amount of money, and you can buy that stock and basically have no impact on the price. Most stocks trade, hundreds of thousands or millions of dollars per day. However, if you have $1 billion and you want to buy $10 million worth of a stock, the demand that you're creating for that stock in such a short period of time will shoot up the price. So that is another kind of drag that is hard for professional money managers to overcome. And this is something that Warren Buffett, the CEO of Berkshire Hathaway, one of the richest people in the world, has talked about for years. Their company is so big that their investment universe keeps shrinking because they have so much money that they need to deploy that they can only look at the biggest and most liquid stocks in the world. However, that's not something that individual investors face because we're working with such small amount of monies that we're not limited to what we can do. However, the biggest reason that professional money managers are at a disadvantage is because they cannot structurally think and act and invest for the long term. The money management business is usually based on very short-term goals. 30 days, 60 days, 90 days, or a long time period for them is 1 year. They are literally judged by their shareholders and by their managers on how their assets performed over the last week, month, or 90 days. And markets fluctuate so drastically over that time period that it's impossible to know if you're doing a good job or a bad job over that period of a time. However, if they underperform the index over, say, a 90-day period, their investors will start to pull assets from them. And they themselves will make less money because they are in the asset management gathering business. So that fact makes them think and act with the short term in mind. They can't buy stocks to hold them for years and years because their investor base are thinking and acting and judging their performance based on a very short time period. Conversely, that's a risk that individual investors don't have at all to think about. An individual investor is not going to fire themselves if they themselves underperform over 30 days or 90 days. So that fact alone frees them up to think and act with the long term in mind. And that allows them to make calculated decisions based on the long-term trajectory of asset classes or individual companies. And that's just a luxury that big money managers simply do not have.
It's interesting because, from listening to you, Brian, if I had money, which I don't, with money managers, I'd be really scared right now because it's not set up to help us.
Yeah, I mean, a very common way to think about it that I like to think about it is that, money managers say that they're in the investment game and that they say, if you look at their perspective, that they're after long-term wealth. But when you look at how they actually get paid, money managers make more money when they manage more assets. How those assets perform does not really impact their compensation at all. A manager that has $10 million under management, if they can grow that by selling themselves and convincing other investors to get to $100 million in assets, that manager will literally make 10 times more money, regardless of how those assets perform. So they are structurally incentivized to grow their asset base. And when you're structurally incentivized that way, what you want to do at all times is be gathering assets and do everything you can to not lose your assets. So because that is their objective and that is how they get paid, that is where they focus a lot of their time and attention. It's simply how they're compensated. So that fact alone kind of prohibits some of the actions that they take and provides some kind of perverse incentives that a lot of them fail to get over. Now, there are some good money managers out there that even with those structural managers are so good at what they do that they can make money for their investors over time and actually beat the index. However, those are typically in the very small minority of investors. But this is why you as an individual, since you have none of those constraints, since you are not trying to invest on somebody else's behalf, and you can think and act with the long term in mind, it allows you to view and analyze businesses and asset classes in a completely different time scale. When I'm analyzing a business, I'm not thinking, what's this stock going to do in the next week or month or 3 months or 6 months? I want to think, what's going to happen to this business over the next 5 years, over the next 10 years, and how will it perform over that time? That's the time scale that I'm thinking of. And because I can take such a longer view, I can ride out bumps, the up and down bumps, so much better than a professional money manager can. So if a company has a bad quarter or a bad year, but I still believe in the long-term trajectory of the business, I am in no rush to sell because I am thinking on a multi-year time horizon. A professional money manager often does not have that same luxury.
Yeah, and what about tax?
Taxes? Yes. So because professional money managers are always trying to essentially prove their value, it's very common for them to churn their portfolio. So they're trying to buy and sell much more rapidly than they should. And it often creates enormous trading costs as well as tax costs for their investors. So if you buy a mutual fund and that mutual fund turns over its entire portfolio in a year, any of the profits that are made are then taxed at the individual investor level. The professional money manager themselves does not pay those taxes. So they have the money manager does not have any incentive to buy and hold for the long term. And here in the States, the capital gains rates that we pay on our holdings varies by how long you hold the asset for. So when you're buying investments to hold them and have them perform for you, it is far more tax efficient often than it is to go with, say, a mutual fund, which is just churning and creating tax consequences for the investor.
Wow. So tell me this, right? As an individual investor, what can we do differently that helps us? Like, what's the benefit?
Well, yeah. So as an individual investor, there's numerous approaches that you can take. One of the most popular and fastest growing is to just be an index investor, which is just you buy a fund that owns the entire market, and it just buys all the companies that exist on an index, such as the S&P 500 or the FTSE, and it just holds all of those companies. And there's no trade, there's very little turnover, there's very little trading, and you will just benefit from the market's return over time at an extremely small price. That's a fantastic strategy for those.
But Brian, what about somebody who's listening to this today and they're not confident about purchasing their own index fund? Why is it so good? Because it's low fees.
It's typically low fees. It's typically much more tax advantage, and there's really no research that goes on to it. If you own the entire swath of the stock market, there's no need for you to do any research beyond I'm going to benefit from the long-term wealth creation of the entire stock market. You don't need to know how to analyze any particular investment statement. Your portfolio will grow right along with the long-term returns of the stock market, which typically average between 6 and 10% per year, somewhere along there. So that's a very easy, low-cost, do-it-yourself method that a lot of people are championing, and I fully support that. However, if people are interested in finance like I was, I am a proponent of buying individual stocks with the goal of holding on to them and trying to outperform the index over time.
Tell me about that. Tell us about buying individual stocks. What do you mean by that?
Yeah, so I literally go out and I analyze businesses. I try and find companies that I think have great economics, great management teams, have lots of long-term potential, businesses that I could see myself being an owner of for years. A great example of that would just be something like Amazon. I became an investor in Amazon over 10 years ago because I was a very happy customer. They were growing like crazy, and the general shift of retail sales away from brick and mortar stores towards online was a trend that I saw just continuing for years. So I just bought some Amazon and just have held it. And the company has continually grown and grown and grown. And even to this day, I think that Amazon still has a very bright future ahead of it. So I am constantly on the hunt for companies like that, companies that have great economics, great management teams, and have a very long runway for growth ahead of them. When I see something like that, I pretty much go out there, buy the company, and then it's my goal to hold it as long as possible. Hold it and watch the company do all of the work, and I get to judge how that company's performance does. And I want to continue holding it and let that company compound my wealth until something happens, until the story changes, or until there's a better investment opportunity. And that's my personal strategy that I've used to outperform the market as an individual investor.
Yeah, I have a friend and she invests in stocks directly with companies and she's financially free. Absolutely.
That's wonderful. That's exactly the goal, right? Is to build up enough wealth for yourself that you have all your expenses covered forever, right?
Yeah, and that's her story. And but tell us a little bit, what are you looking at? Are you looking at financial statements, profit and loss? What you're watching trends, right?
I'm not so much watching trends as I'm looking for trends. I look at kind of all aspects of the business, and this is another thing that separates an individual investor. So I have a checklist that I use to go through every individual stock, and I'm happy to link to it in the show notes so that your readers can go through and see my investing process. But I look at their financial statements. I want to see strong revenue growth. I want to see margins, which is how much profit they make when they sell something, growing or expanding. I want to see that they are addressing a huge market. I also care deeply about the culture of the business. I want to see that their employees are well cared for. So one thing that comes out every year on a site called Glassdoor.com is the 100 best employers to work for in the United States. That, to me, is a great list of companies to look through because if a company has a great culture that attracts the best and the brightest minds, that's a company that is going to be built to last. That's a company that I believe will be able to grow better than companies that have terrible relationships with their employees. But again, if you were a professional money manager and you were planning on holding a stock for 30 days or 90 days, why would you care if it treats their employees well or not? That simply doesn't matter to you. But if you're investing in a business for 5 years or 10 years, that really matters to you. You want a company that's attracting talent, that people want to work for, that retains their employees. So that's something that I use in my investing checklist, for example. And I also see how the management has performed. What are their incentives? Do they own the stock themselves? So I just use a checklist to kind of go through and find out if it's a quality company or not. If it is, I buy it and I hold it. If it's not, I just pass completely.
Brian, I love this. I love, this is so valuable. And I know our listeners are going to get a lot from this. So, Brian, tell us a little bit about you, your own personal portfolio. You changed brokers in 2013.
Yes. So I've been investing and buying my own stocks for more than 15 years now. However, in 2013, I did change my brokers, and it's kind of hard for me to get longer term data than that. But since 2013, my portfolio has returned about 256% using a long-term investing style. Compare that to the S&P 500, which is a rough proxy for the U.S. stock market. Over that same time period, they returned 150%. 148%. So I'm up over 100% on the index over the last 6 years. The total world stock market, which is an amalgamation of every single publicly traded company in the world, is up about 98% over that time frame. So again, I'm up 256% versus the market. So I am convinced that if you can search the market for the best businesses, find them, buy them, and importantly, do what professionals cannot, which is hold them for the long term, that there is an advantage to buying and holding your own stocks. But that is certainly not a strategy that is for everybody. You have to be willing to do your own research. You have to be willing to think independently, and you have to be willing to hold when bad things happen to your stocks. So for people that are not interested in this subject, index funds are just a great do-it-yourself, low-cost, easy way for them to get great returns over time.
Brian, I really love this conversation. In fact, this is going to be one of my favorite conversations. So tell us, Brian, for the listeners out there who say they're listening to this, they're really inspired and are like, I really want to get going. What's that kind of first thing you would say to them?
Oh, I mean, just to start reading books. If they're interested in just the markets in general, John Bogle has a number of books out there that just talk about simple ways to invest in index funds. For people that are interested in a little bit more deep dive research, there's a wonderful book called Warren Buffett and the Interpretation of Financial Statements that walks through all of the financial statements and how Warren Buffett himself thinks about analyzing a business. So I found that book to be very useful for teaching me the basics of accounting. So those are two excellent resources for people that are interested in this subject to dive into.
Thank you, Brian. And Brian, how do we find out more about you?
The best way to connect with me is just on Twitter, which is at Brian Feroldi, and they can also find me on Fool.com. I'm one of the regular contributors there, and if they just search for Brian Feroldi, they'll see all my articles that come out.
Thank you, Brian. And you're going to share that lovely link with us that you were mentioning.
I certainly will. Yes, that is the complete checklist that I use to analyze stocks. So that's also another resources that people can use if they like my investing style.
And if people are looking into companies, right, to invest in stocks directly into the company, the book you'd recommend would be the Warren Buffett, learning about financial statements.
Yes,
Is there other ones?
That's a great one. Oh, sure. There's a number of books that I'd be happy to send to you about stock picking. I mean, there's an endless supply of books about investing, but that Warren Buffett one that I mentioned is a great one for just a primer on accounting and how to use accounting statements to how to interpret accounting statements, which if you're interested in picking your own stocks is a must. Accounting is the language of business and you need to know how to do that. But I'd be happy to send you a more detailed list of other books that I recommend that you can put in the show notes.
That'd be great, Brian. Thank you. This has been amazing. I really personally enjoyed this and I can't wait to share this with everybody.
Excellent. Thanks so much for having me, Lorna.
Hey everyone, remember to join us in the Private Financial Freedom Podcast Facebook group with me, your host, Lorna Poole. This is a safe haven of like-minded wealth-getting go-getters who, like you, are on their journey to creating financial freedom in their life. This is where you and I can get intimate. I can give you the support and guidance to go from where you are now to where you want to be, developing your wealth mindset and creating your financial freedom life. Join at www.facebook.com/groups The Financial Freedom Podcast. You will see the links to this on the website. It's in the show notes, or type it into the Facebook group. All you have to type in is Financial Freedom Podcast and you will see us there. Look forward to seeing you in the group. Take care. Thank you for joining us on the Financial Freedom Podcast to creating wealth, investing, and developing your money mindset. To get started today on your journey, head on over to www.lornapoole.com and grab your free course, 5 Steps to Breaking Free from Your Poverty Mindset and Accelerating Your Journey to Financial Freedom. See you there.